Good morning. It's Tuesday, April 15th. Thanks for joining me. I'm Philip Streible, Chief Market Strategist at Blue Line Futures. So yesterday I had the pleasure of being a guest on 5 on Ives, which is CNBC's worldwide exchange host Frank Holland and legendary tech analyst of Wedbush Securities, Dan Ives. It's a podcast that they launched, and I was discussing the US dollar, gold, interest rates, and I'll post a link to that video in the Metals Minute email blast. So taking a look at the US equities, US dollar, gold, and interest rates, we got the S&P 500. It is down 8.1% year to date. A key level that I had discussed yesterday as we ran into resistance is about pocket resistance 5,500 to 5,564. That's where April 2nd, Trump goes to announce the tariffs. When does he announce them? It was after the close here on April 3rd is when we had that collapse. So pull up a daily chart. You'll see that collapse take place. Where are we at right now? Well, it's a return to the scene of the crime. So we're getting very close to it here. About 50 points away from that 5,500 region, but we got right up against it here yesterday, and then we started this sell-off. So old support, new resistance, and a bull battle line right there. So looking at a couple things here, Bank of America, they did have their global fund manager survey, and the investor sentiment regarding the economic prospects is the most negative in 3 decades. 82% of fund managers are expecting the global economy to weaken, and a record number intend to reduce exposure in U.S. equities. So many of these rallies we've seen a rug pull on them, and as a lot of these fund managers kind of lightening up positions. And it's because 42% say that a recession is the likely outcome. Now, on the tail risks in the crowds, one thing to note is that 49% of them said that the long gold trade is the #1 most crowded trade. So that gives you an insight as far as their client positioning is concerned. There's been quite a bit of allocation to the gold market, gold ETFs, gold futures, and things like that. And if you look at the charts here, we are a bit overextended on the upside from that previous channel we're in, but we're going to want to continue to monitor how 3201.60, that was an old resistance point. That was the old all-time high. Now could be that new support level, and then we'll want to look a little bit below that as far as where that upward sloping line is as your next major support level. So shifting gears here and looking at Boeing stock, that's been the latest trade war victim. China has ordered its airlines to stop taking deliveries of Boeing jets and to halt purchases of the aircraft related equipment and parts from the U.S. companies. So the move is seen as an ongoing trade war escalation between the U.S. and China, where China imposed retaliatory tariffs of 125% on American goods, including those aircraft and parts. So the standoff is a setback for Boeing, which relies heavily on the Chinese market, and it could impact the company's sales and supply chains. So we're seeing prices of Boeing come off in the pre-market here. Now looking on that trade war front, the US dollar, the dollar's been down for 4 straight sessions here and really breaking down here below that 100 level, and it was really the breakdown below the 102 where things really started to sell off. And what we saw was wild volatility in the treasury market with yields falling to 3.84% on the recession fears, and then they popped to 4.52. Why did they pop? Why did we see the bond market move and the treasury market and the dollar collapse and gold go up $250? Well, it is a foreign buyer strike on U.S. treasuries. So when you impose tariffs on people, when you impose tariffs on different customers out there, well, they're just not going to buy your product. And that's where things went into the gold market, and we saw the dollar index really come off quite a bit. Now, historically, when you look at the dollar, and the IMF puts out this data, the dollar is about down 12%. And since January, it's hit a 3-year low, and the IMF data shows that dollars held by non-U.S. governments as a percentage of total FX assets have fallen to 58%. It's a level not seen since the 1980s. Where'd that money go? Well, it rotated into that gold market there. So we want to keep an eye on the dollar, treasuries, and the gold on how they're all interconnected. We'll keep silver and the industrial metals in this different risk bucket, in this different asset class, and that's why we're seeing that 100 to 1 on the gold-silver ratio. Now, looking at some earnings coming out, we did have Bank of America come out, a little bit of volatility in the U.S. equity markets. We'll also have Johnson & Johnson as well. Not a big holding name here, but some of the more legacy portfolios would maintain those types of positions. Looking at the treasuries and the CME Fed watch tool, that's something we haven't discussed in a while, but as we get closer to that next Fed meeting and these kind of tariffs kind of play out and they settle into where the administration is going, we want to look at that May 7th meeting. So 22 days away, 17% chance of a 25 basis point interest rate cut. You go out to June 18th, about a 72% chance. So checking in on the precious metals, we do have platinum, palladium making new highs right now. Gold futures up about $13. They were under pressure most of the day yesterday. We've got the silver market up about 14 cents at 32.30. So all of them tacking on some small gains here and there. The gold silver ratio did drop to about 99 to 1 at one point yesterday. So key levels to watch on the gold market again is that 32.01 level and then 32.63 because that's the record high on the June futures contract. So looking at the price last here as of this recording, 32.39.60 here, up about $13. So it's driven by the concerns of the Trump administration. They are probing into semiconductors, the pharmaceutical imports, which could broaden that U.S. trade war. So we want to watch an eye again on some of this other rhetoric here. So banks like Goldman Sachs, UBS, they remain optimistic on gold's price forecast, and they put out estimates in 2026 of $4,000 an ounce by mid-2026, driven by that strong demand from China and the potential dovish moves by the Federal Reserve. So that's why we want to start watching the CME's Fed Watch tool as we trickle along into the year. We get closer to those Fed announcements. We want to see if any of those probabilities of interest rate cuts, if they are rising. Now, an interesting story that I am monitoring pertaining to the gold market, which could pertain to copper and silver and things like that, is that the gold market, it flooded, the bullion flooded into warehouses and the U.S. exchanges here. And it was driven by that tariff-driven arbitrage. Now that trade is starting to slowly fade away, and it's starting to see some of the risk premium and some of the spreads between different exchanges really come out, because the arbitrage opportunity, it really ended once Washington confirmed that the bullion would be exempt from President Trump's tariffs, causing COMEX stockpiles now are starting to decline again. So we could start to monitor that. Maybe they get too tight. Maybe they were too overextended here. So the price difference between the front month COMEX futures and the spot gold price in London is narrowing to about $15. So the storage costs in New York, they may kind of encourage traders to pull some of that bullion out and bring it back to London or Asia. Now looking at the ETF flows, because this is really important here, because this is the other dynamic that we're watching. And if we're going to see silver squeeze higher, if we're going to see gold squeeze higher and things like that, we want to watch the flows into the ETFs. And we saw gold, another big jump here yesterday. Silver, another big jump yesterday as well. So the exchange traded funds, they added 400,000 ounces of gold to their holdings in the last trading session. And that was the fourth straight day of growth. The ETFs added 2.69 million troy ounces of silver holdings in the last trading session. So silver plus 1.4%, gold plus 7.5%. So checking on some outside markets, we are seeing Bitcoin start to rise here again after stabilizing. The grain markets came under a little bit of pressure in the overnight session, but corn's up about 2 cents. The foreign currencies here, we're seeing no big moves into any of the foreign currencies at the moment, with the dollar index slightly positive. And checking on crude oil here. Crude oil futures giving up some of its gains, but still holding above that $60 level. The benefit of crude here is that you've got the roll forward premium, where the farther out you go, the cheaper that it gets. And that's because the International Energy Agency slashed its forecast for global oil demand this year due to the brewing trade war and predicting a persistent supply surplus. So they noted slower consumption growth in 2026, a fragile macroeconomic environment, and the rising popularity of electric vehicles. But I think that's slowing down just a little bit here. So the EIA lowered its estimates for new supplies outside OPEC this year, but still expects production to outpace demand. So we're going to want to start to look at crude oil, but perhaps just a little bit lower. If you get the tactical ranges, we'll start looking at those lower 2-level, 3-level, things like that, where there's any kind of washout on the energy prices as far as potential opportunities there. So a little bit quieter on the front here of things. We'll see if any of those dialogues persist with with the administration, with tariffs and things like that. I know it's really important to monitor different press conferences and things because oftentimes it's going to move the markets here. So you got any questions, reach out to us. We love to work with you over here. Very easy to open up an account. You get a lot of great research from us and you get the insights because eventually we're building this portal right now and it's almost done. And then we're going to take down some of these videos here and not publish them on a daily basis, but perhaps once or twice a week. So you got any questions, reach out to us, give us a call. And remember that futures and option trading, it does involve risk of loss and it may not be suitable to all investors. Good luck, good trading, go get them.